Hey, everybody, I hope you're doing well today. Let's take a look at the financial account, understanding what it is. This is the third video in the balance of payment series. It really helps in this unit to watch all of them together because you're building little pieces of an equation that ultimately adds up to zero, which means that the payments coming in and out of a country have been balanced. Okay, so the financial account is a second part of an equation that equals zero, which equals balance of payments. Let's take a closer look. All right, a reminder, right? There are two main parts to the balance of payments account: the current account, which was the last video, and the financial or capital account, which is this video. Key point, it's what I just said. The current account plus the financial account will always equal zero, which will be balanced. Always balanced means, let's write it nice and big. Balance means zero, right? So that means, if you think about it, that means that the current account will be a negative number or a positive. If the current account's negative, the financial account number is going to be positive. If that's positive, that's going to be negative. Why? Because if you add two things and they equal zero, it must be, one must be positive and one must be negative. Okay, as to why that's the case, it's going to come clearer as we move along. If that's not making sense to you yet, chill out, it will in a little bit. All right, here we go. Let's go on to the financial account. All right, quickly, the definition. Don't get intimidated by this language. The financial account measures the net change in foreign ownership of domestic financial assets. Net change. That means, and this is a really nice image to have for your pictures of financial account. You're going to have one arrow flowing out of the country, right? And you're going to have another arrow flowing into the country. If one is longer than the other, right, like I drew them, then if this is flowing out, that's more money going out of the country than coming in. So you're going to have a deficit. If it were the opposite, right, and this is money coming into the country, let's say the country's now over here, and this is money going out of the country, then you're going to have a trade surplus. In what area? In the financial account area. What does that mean? That means direct investment, portfolio investment, or reserve assets, right? Direct means directly buying something in another country. Portfolio means investing in government in countries. Sorry. Direct investment means actually buying a thing in another country, a business or land. Portfolio means that you're buying some stocks in a company. Reserve means currencies or gold or something else. Okay. So if the financial account surplus, if you have that, then you have the situation where there's extra money coming into the country. So in that case, right, our country, our fictitious country would be over here. So what does that mean? If ownership of domestic assets increase more quickly than domestic ownership of foreign assets, then there is more money coming into the country than going out, and so there's a financial surplus. Yes, that makes sense, right? But if you were to take the country and imagine that we're over here, right, make this red over here, then what would it be? It would be a deficit. Why? Because there's more money leaving this country than coming in. So you would have a financial account deficit if domestic ownership of financial assets increases more quickly than foreign ownership of domestic financial assets. Then there's money going out of the country, more money going out of the country than coming in, and this is a deficit. This just means that if you live in the red country, there are more people in your country buying up pieces from the white country than there are people from the white country buying up pieces of the red country. But what kind of pieces? Well, this is long-term assets, things that are like, I don't know, property, buying property, direct investment. The red country is buying property in the white country more so than the white country is buying property in the red country. Portfolio, what does that mean? Oh, well, that just means a measure of stock and bond purchases. So in this case, more people from the red country are buying stocks and bonds in the white country than people are buying companies that are from the red country. Reserve assets, what's that? That's the reserves of gold and foreign currencies, which all countries hold that are itemized in the official account. And that just means that they in the end, right, this country is going to end up with more money than this country because the white country has more money coming in. Dude, it's really simple. It's just addition. It's just logic. It's just arrows and silly countries called the red country and the white country. You can draw this anywhere. All right. So let's get on to some real econ language. All right. So what does all that mean? That's all nice and fine to put it in casual language. Well, look at this slide. This slide's money for you, right? This will explain anything that you need to know. What do we have? Direct investment, portfolio investment, reserve assets. That's what I just talked about. And direct investment is a measure of the purchase of long-term assets, or the purchaser is aiming to gain a lasting interest in a company in another economy. So this is a United States person buying a piece of a company that is in Spain, right? This includes such things as buying property, outright purchasing a business, or purchasing of stocks or shares in the business. In all cases, the asset is expected to have a positive return in the future, making profits or increasing in value over time. The investment does not have to be paid back, and there's no guarantee that it will provide a positive return. Much of the activity in this category is the form of foreign direct investment, or FDI, by multinational corporations. We're going to get into this later on. Foreign direct investment. It is a foreign country directly investing in another country. Yeah, so that's U.S. directly investing in a company in Chile. Yeah, okay, cool. So direct investment. If the arrow leaving your country, right, is the red arrow is bigger than the white arrow, oops, wrong one, then the white arrow, guess what? That one's shorter. So the red country would have a surplus, and the white country, the white country would have the surplus now, right? And the red country would have the deficit because this one's more going out. All right. Now, next item. Okay, portfolio investment is a measure of stock and bond purchases which are not direct investments, since they do not lead to a lasting interest in the company. Direct investment is like you buy up 40% of the company, you're going to hold on to it a long time, right? Portfolio investment is like, I live in Chile, I'm going to buy like 100 shares of Apple stock. That's nothing compared to the total value of Apple, right? So they tend to consist of the buying and selling of things such as treasury bills and government bonds, maybe. We will also include savings account deposits in this category, although in many countries it comes under the heading of other investment. In all portfolio investments mentioned above, the investor is putting forward the money in order to purchase the assets in the expectation that interest will be paid on the investment and that money will be repaid in a given period of time. These assets are simply borrowing and lending in the international market. Okay, so all that's really saying, right, is that I am a Chileno and I'm buying U.S. stocks and I can sell it whenever I want. Right? I'm a German and I'm buying English stocks, right? That is another example. You're going to add those up, right? At the end, the financial account's going to say, okay, which arrow's bigger? Well, same thing happened here. Check it out. Same thing. Wow. Look at the red arrow is bigger than the white arrow. That means that at the end of the day, right, the white country is going to have more money than the red country because there is more money leaving the red country going to the white country than there is white money coming to the red country. Hey now, coming clean, and those are going to be netted out. And lastly, the reserve assets are the reserves of gold or foreign currency which all countries hold, which are itemized in the official reserve account. It's the movements into and out of this account that ensure the balance of payments will always balance to zero. If there's a surplus in all of the other accounts combined, the official reserve will increase. If there's a deficit, then of all the other accounts combined, the official reserve will decrease. It is net changes in the official reserves account over time that balances the account. Dude, what is that? What does that mean? This is a bunch of words. I don't get that. Okay, watch this. All right, so here's my arrow from the red country, and it's obviously longer than my arrow coming from the white country, right? So here is my white country, and here is my red country. Okay, which arrow is longer? Boy, I drew them almost the same. I drew them almost the same size. Hold on a second. What one is longer? Well, I'll just tell you. The one that's longer, right, is the red one. So that means that there's more money leaving here and going to the white country, which means that there's going to be more money more reserves accumulating there than there will be here, right? Assuming that the red, this red line is longer, that's more money going over here. That means that there will be more money in the white country reserves than are coming into the red country. Okay? And it's these financial reserves, and this might not make sense right now, but these financial reserves, these reserves in other foreign currencies that enable countries to balance out their payments. Okay. All right. If that doesn't make complete sense, have no fear, it will as you go through this understanding, right? We're just finishing up the financial account aspect of balance of payments. It's one half of the equation. All right, a special note, and this is, I love this stuff in econ, right? Of course, in reality, the balance of payments account will not actually balance. What? And you just said it always equals zero. I love economics. You're always half telling the truth. This is because there's simply too many individual transactions taking place for the measurement to be exact. And there will always be some transactions that have not been recorded when the figures are being put together. To resolve this, economists are cool, man. A balancing item, which we'll call net errors and omissions, is put into accounts to ensure that they do, in fact, balance. So if they don't really balance, then you just go ahead and say, hey, you know what? No, they balance. They really do balance. No, seriously, they balance. They balance. We'll just call it something like net errors. Net errors. Yeah, we don't know what the errors are, but let's just call them net errors, and we'll give them 3 stars. No, we'll give them. I think we need to give them 5 stars because that is cool. Because that's true. Ultimately, they really do balance out. The logic is there, but the numbers aren't. And so economists just go, yeah, well, hey, look, we just don't have all the information. There are too many transactions. They can't all have been recorded, but really they do balance out. Okay. But as time goes by and trading accounts are revived over the years, more data comes to light and the balancing items invariably get smaller. Yeah, but they don't actually work. So you have a bailout as an economist. If the numbers don't add up perfectly, then you take the difference and you just call it net errors and omissions. And then the answer will always be in economics and balance of payments. It couldn't be called balance of payments if the equation didn't equal 0 and the 2 accounts actually balance out. Rock on, my friends. I hope you thought this video was helpful, and we'll talk to you in a bit.